Hello, my name's David Miller. I'm the manager of Nexus Global Solutions portfolio and the co-manager of Dynamic. It's early March and I'm speaking to you from London. Well, these are not easy times. The coronavirus went global during February and that caused a sharp setback for equity markets. Essentially, short-term confidence cracked and financial markets reacted. So let's get straight to the facts, the performance of the portfolios. A reminder, in 2019, Solutions delivered a return of 14% and Dynamic approaching 23%. Excellent numbers. Year to date, the returns are -4% and -9%. So that puts things in perspective. We've given back a little bit of the return made last year. So that's where we are at the moment. In terms of asset allocation, Dynamic is about 95% invested in global equities, 5% in cash. Solutions is the more diversified portfolio, which is why the performance has been better in the short term as uncertainty has increased. It's about 54% in equities, 30% in cash and fixed interest, and the balance of 16% in alternatives. What have we been doing? Well, the focus remains on stock selection within the equity part of the portfolio, looking at companies that have sound balance sheets, good business plans. They're not dependent on borrowing money to survive. That's always been our approach and that's paying off at the moment. These companies also pay dividends. The portfolio yields are around 2% and that cash flow through the income account is very valuable at a time when interest rates are close to zero and bond markets are heading that way as well. On the alternatives side, the focus is on hedge funds that deliver returns in a slightly different way to equities. And over February, when markets fell away, the hedge funds we're invested in were flat. Gold has been a positive, as has infrastructure. On the other part of the portfolio, fixed interest, the emphasis there is very much on quality. Government bonds, good quality corporates. We're interested in companies that are able to pay interest and pay us back our capital when we want it. And that area of the portfolio made money in February as equities fell away. So that's where we are at the moment. Not brilliant in terms of return this year. We all like to make money every month. But in part, I think we've been working towards preserving the returns that we made for investors last year. So what next? Undoubtedly, the coronavirus impact is reducing economic growth, and it's quite likely that we will head into a recession this year. The big question is how long and how deep. Markets at the moment have probably discounted a slowdown lasting about 6 months. So the first half of this year and into the summer months, followed by a recovery. This is all guesswork at the moment. We obviously don't know that. But that's what I suppose is in the price. Secondly, governments, central banks are taking action to support confidence to generate growth. Lower interest rates from the US, we're likely to see further cuts in rates elsewhere in the world. Money is being pumped into the system to ensure liquidity. Governments, including the German government, which in the past has been averse to spending money, are looking at ways to stimulate demand by spending without taxation. In fact, the French are thinking about asking for tax to be paid in order to help their companies. These are all positive things, and as we found out over the last 10 years, cheap and plentiful supplies of money are very powerful when it comes to stabilizing markets. But it isn't all over yet. When I said that the markets had discounted 6 months of uncertainty, that uncertainty could carry on further. And that's where we're actively monitoring the information as it comes out, judging what the companies are doing, judging the impact on profits and business plans. As Lord Keynes said, if the facts change, I change my mind. We're actively engaged with markets and we're looking very carefully at what we're invested in order to ensure that it makes sense in this new world that we're now living in. So I think that's where we are at the moment. I don't want to go on too much about the finer points of what's going on medically or within the economy, but I think the overall message is that these are good quality portfolios invested in good companies that are in business. The management of those companies is making decisions in the light of the reality we're grappling with. We're making decisions based upon value and potential return in the future. That's what our approach has been over the years, and that's what we're doing right now in the middle of this uncertainty. So I hope these comments are of use, and all being well, I look forward to reporting to you in a month's time. Thank you.